Welcome to Trading an Edge, the podcast where we break down the psychology, mindset, and system of elite trading. Today, we're diving deep, really deep, into something that honestly could reshape how you approach trading entirely. Our mission, it's simple. We want to dismantle this pervasive myth about needing to predict the market. We're here to reveal what we think is the real holy grail. It's not about guesswork. It's about, strategically optimizing your risk, your reward, and how often you trade. That's how you compound a positive edge into consistent returns. And look, here's a truth bomb for you right at the start. You don't need to be right most of the time. You just need to make more when you are right than you lose when you're wrong. And then this is key. Repeat it with discipline. Simple, but not easy. We've got some powerful insights lined up for you today, and I'm genuinely excited to get into them.
Absolutely. And it's so important to frame this right. True trading success, it really has very little to do with having some kind of crystal ball. It's not about predicting the future day in, day out. It's more fundamental than that. It's a shift in perspective. Think of it less like fortune telling and more like, running a probability-driven business, guided by discipline and your system. It's about focusing on what you actually can control.
Okay, let's unpack that.
Yeah.
Because so many traders, and yeah, I definitely did this, starting out, they spend years looking for that perfect system. The one indicator, the magic signal that tells them exactly what the market's going to do next. It's this constant hunt for certainty.
Exactly.
And everything we've seen suggests that's...
Well, it's not just common. It's usually a dead end. Right?
Yeah, it really is. That magic bullet just doesn't exist. So if prediction is off the table...
Then what are we left with? What can we actually do? Okay, so if we're not predicting, we need a totally different framework. The core idea, if you look at it clinically, is to treat trading like a probability engine. I mean, think about it. Every single trade you put on is a decision made with incomplete information, under uncertainty. After you hit buy, the price basically does one of two things. It goes up or it goes down. At its most fundamental level, that's pretty close to 50-50, isn't it? Like flipping a coin. So our specific definition of an edge comes down to the expected value. Mathematically, it's your win percentage times your average win minus your loss percentage times your average loss. Put simply, it's what you mathematically expect to make or lose on average per trade. This isn't about guessing the coin flip. It's about structuring the payouts when you guess right or wrong.
Okay, and that's the critical point then.
Yeah.
If the market's direction is kind of like a coin toss, where does the trader's skill or control actually come into play? How do you influence that probabilistic game?
Precisely. So consistency in trading. It's not about predicting the coin flip correctly every time. It's about throughput. That means systematically repeating trades that have a positive expected value, or EV. You don't control where the market goes next, that's true, but you have absolute control over other crucial things, like your payoff asymmetry, that's your risk-reward ratio. You control your position size, and you control your opportunity frequency, how often you find and take trades that fit your edge. Throughput is about maximizing the number of times you can apply that edge effectively. The goal isn't certainty on any one trade. It's cultivating a repeatable advantage over many trades.
Right. And this is where, for me, it gets really interesting. If it's probabilities and we can't predict, how do we actually tilt those odds? How do we make the game favor us? You mentioned risk-reward.
Yes, and that's arguably your most powerful lever. The most effective way to tilt those odds, it's by deliberately targeting a favorable payoff ratio. Specifically, and this is a number worth remembering, aiming for at least a 3-to-1 reward-to-risk ratio. Think of that as a cornerstone for building something sustainable. Let me give you a concrete example. Imagine a setup where you aim to capture a 15% gain. But critically, you only risk 5% of your capital if you're wrong. That specific 3.1 structure creates a statistical edge. It means that even if your win rate is only, say, 40% or 50%, which means you're wrong more often than right, you can still generate profit consistently over time because your winners are 3 times bigger than your losers.
It's almost frustratingly simple when you lay it out like that, isn't it?
Yeah.
Yet so many people, myself included back in the day, make it way more complicated.
But to be even clearer, it's like, imagine you have the special coin, right? And when it lands heads, you win $3. But when it lands tails, you only lose $1. Now, even if that coin is perfectly fair, 50-50 odds.
You'd want to flip it. You'd want to flip that coin as many times as you possibly could, because the math is clearly on your side. The more flips, the more that mathematical edge plays out.
Exactly. And it highlights that the secret isn't really about trying to avoid losses altogether. Losses are inevitable. They're just part of the statistical landscape of trading. The real key is discipline. Keep those losses small, consistently small. And just as importantly, allow your winning trades the room to run, to expand. That ensures over a series of trades, your wins dramatically outweigh those small, controlled losses.
Okay, but what about the allure of the big win? That one stock that goes parabolic, doubles, triples. The story you tell everyone. It's tempting to chase that. Why is focusing only on those huge, rare gains often a trap? What's the smarter play?
Well, connecting this back to the idea of throughput and opportunity cost. Waiting for that single, massive, 100% gain. That can tie up significant capital for weeks, maybe months. And while that capital's sitting there, waiting, you might have missed dozens of other perfectly good opportunities for smaller, quicker gains. That's opportunity cost in action. The goal isn't always the maximum possible gain on one trade. It's often the optimal game that lets you turn your capital over, apply your edge more frequently.
That clicks. It's like you said, stop hunting for lightning strikes. Don't wait for that miracle trade. Instead, think about building a flywheel. Small, clean, repeatable gains, they spin that wheel faster and faster. They build momentum.
Right.
Whereas those huge, rare jackpots, they might feel good in the moment, but they often stall the whole process. They don't compound effectively. I remember doing that, fixating on one trade, hoping it would double, while ignoring 5 other solid 15–20% setups. Big mistake.
Let's put some math behind that flywheel idea. Compare chasing maximum gains versus compounding optimal ones. So, one trade gives you 100% return. Great, total return is 100%. But what if instead you make 4 trades, each yielding 20%? If you compound those returns, you actually end up with about 107% total return, more. Now take it further. What about 8 trades, each yielding just 10%? Compound those, and you're looking at roughly 114% total return, even better.
And the kicker is, finding multiple 10% or 20% opportunities is usually way easier and happens much more often than finding that rare 100% moonshot.
Exactly. It's far more frequent.
So focusing on these optimal, repeatable gains. It's not just more efficient, it's actually a more reliable path to consistent profit. This really changes the whole objective for a trader, doesn't it?
It absolutely should. Trading isn't about maximizing gain on any single event. It's about compounding optimal gains, repeatable gains, with efficiency and flexibility over the long haul. Let me use one more metaphor. Become the casino. What does the casino do? It caps its losses on any single bet, allows for potentially large wins for the player, uncapped upside from their perspective, and then just lets the math, its inherent edge, work out over thousands and thousands of trials, of hands dealt, of spins of the wheel. They don't predict the outcome of the next hand. They rely on the probabilities playing out over volume.
Okay, this all sounds incredibly logical. It's math, it's probability.
Yeah.
So if the principles are this clear, why do so many traders, even smart ones, struggle so much to actually do this consistently? What gets in the way?
Now we get to the really tricky part, the psychology. What's fascinating and challenging is that truly successful trading demands this fundamental mindset shift. You have to move from seeing each trade as this isolated win or lose battle to adopting a much more detached statistical perspective. But there are powerful psychological forces constantly working against that. Think about these. Ego chases the maximum gain. Professionalism banks the optimal gain. Fear makes you hold losers too long, widening losses. Discipline cuts them ruthlessly. Impatience leads to overtrading, taking low probability setups. System faith allows you to wait for the right pitch. These are real internal battles every trader faces.
It really highlights that psychological maturity in this field isn't about somehow becoming emotionless like a robot.
No, not at all.
It's more about making a conscious choice, choosing the repeatable edge over the dramatic, ego-boosting outcome. It's about accepting losses as just, a cost of doing business in a probabilistic world, and keeping your focus firmly on the long-term expectancy, not getting knocked off course by one losing trade or even a string of them.
That's perfectly put. Emotional detachment, or maybe emotional regulation is a better term. It isn't just nice to have, it's a prerequisite for consistent execution. And at the end of the day, that consistent execution day in, day out, following the rules, that's far more critical to long-term success than occasional flashes of brilliance or that one lucky home run. It's the steady hand that builds wealth in trading, not the wild swings.
Okay, so for our listeners who are nodding along, who are ready to ditch the myths and adopt this professional, probability-driven approach, what's the practical roadmap? How do they actually start building and executing this repeatable edge, step by step?
All right, let's break it down into a clear, actionable 6-step framework. This is about building consistency. Step 1, define your edge, quantify it. You need to know or at least estimate based on backtesting or initial results your expected win rate, your average win size, your average loss size. And crucially, set your target risk-reward ratio. As we said, aim for 3.1 or higher if possible. This is your quantitative blueprint.
Got it. Numbers first.
Step 2. Codify your setups. Be specific. Filter your trading opportunities down to only high-quality conditions. These are setups that historically or logically should either raise your win rate or improve your average risk-reward ratio. The goal here is ruthless. Eliminate the low-probability noise trades that just waste capital and mental energy.
Okay, filter ruthlessly. What's next?
Step 3. Enforce risk. This is non-negotiable. Before you even think about entering a trade, you must predefine exactly how much you're willing to risk. Place a hard stop-loss order and automatic exit if the price moves against you to that predetermined level. And here's the critical discipline part. Never move that stop-loss further away from your entry to give a losing trade more room. Protect your capital above all else.
Never move the stop. Crucial. Step 4.
Step 4. Systematize your exits. Plan your profit-taking, too. Aim to take profits not necessarily at the absolute peak, but where your expected value analysis suggests it's optimal. This also involves quickly recycling that freed-up capital into the next qualified setup. This increases your frequency, your throughput, keep the flywheel spinning.
Measure and adapt.
Step 5. Measure expectancy. Yes. Rigorously review your performance. Track your rolling expected value. Monitor your drawdown statistics, how deep the valleys are in your equity curve. Use this hard data, not emotion, to continuously refine your rules. Look for ways to incrementally increase your win rate, improve your risk, reward, or just execute more cleanly. It's a constant feedback loop.
And finally,
Step 6. Scale with consistency. Only after you've demonstrated that your positive expected value and your execution quality are stable and consistent over a meaningful series of trades. Then you can consider gradually increasing your position size, risking more capital per trade. Don't scale up just because you had one big win. Scale up because your process is proven consistent. Consistency first, then size.
wow, okay. That framework really lays it out. It provides a clear, disciplined path away from chasing luck, away from guessing, and towards actually executing a probability-driven edge like a professional. It turns trading from prediction into management. So let's wrap this up. The core revelation from this deep dive, the big takeaway, the real holy grail of trading isn't some secret prediction method. It's simpler and harder than that. It's the disciplined combination of a favorable reward-to-risk ratio aimed for that 3.1 or better. It's consistent execution, flipping that profitable coin as often as your edge appears. It's the unwavering discipline to cut losses quickly, ruthlessly, while letting those winners run. And finally, it's understanding and harnessing the incredible power of compounding those reasonable, optimal gains over time.
Which leads to, I think, a really pointed question for everyone listening to consider. Are you currently chasing those rare, unpredictable home runs, hoping for the big score? Or are you systematically, patiently compounding a repeatable edge? My advice: abandon the prediction theater. Focus on optimizing your risk, your reward, and your frequency. That's how you step into professional consistency.
And maybe take that a step further. Pull up your records, look at your last 10, maybe 20 trades. Ask yourself honestly, which path are you really on right now? The answer might surprise you. Thank you so much for joining us on this deep dive, Trading an Edge, where psychology meets profitability.